Hello and good morning. I'm Edgar Kardashabe. This is Traders Next Door, and you're about to hear the Daily Scoop. Now, after an action-packed week last week with NAS, US 30, SP 500 reaching all-time highs, we had Donald Trump being elected into the White House, we had the Fed dropping interest rate cuts again by 0.5 basis points. We had a lot of movement last week. This week, not quite as action-packed, but still very important. We have CPI coming in tomorrow at 3:30, and whereas CPI might not be the juggernaut that it used to be, it is still a very important data release figure. So jumping into it, let's explore what CPI is going to look like this week. Now, CPI, for those of you who are new here, stands for Consumer Price Index, and it measures what the prices have increased of everyday items such as food, energy, and housing. When CPI goes up, this signals a slight rise in inflation, which can typically influence what the Fed wants to do on rates. Now, the Fed has said that they're not looking as closely to inflation to impact their decisions moving forward, but a surprise either way is still going to be a data set that they are going to consider in their run to 2% inflation, the magical soft landing that they've been talking about for months. So this month's CPI is going to be somewhat still important of what the overall trajectory of things is going to look like. Now, CPI this month is expected to stay flat across the board, with CPI month on month expected to stay at 0.2%, core CPI month on month to stay at 0.3%, and CPI year on year expected to stay at 2.4%. Now, even though things are expected to remain flat, this does mean that it is very easy for the market to surprise either to the upside or the downside, which could lead to some volatility. The US dollar has been on a massive bull run for the last several weeks, so a lower than expected CPI print could signal that inflation is dropping a little bit faster than expected, and this could result in a halting of that massive bull run. Conversely, if we get a massive print to the upside, it would mean that inflation is not coming down as fast as we expected. Ironically, this would lead to a slightly more bullish dollar and would lead to slightly more volatility in that direction. So it's going to be very interesting to see how the CPI data actually prints out. Last month, we saw an increase over the expected projections of what CPI was going to do, and this instilled a nice little bullish run on the dollar in the short term with that volatility. So it's going to be very interesting to see if something similar happens tomorrow. And if you're looking at predicting which direction CPI is going to trend towards, there is some data you can look at that might help you build a thesis as to what you can expect. So if we look at previous data releases such as PPI, the Producer Price Index, this is a measure of what the average selling prices of those products have been for the producers. You can think of it as CPI's sister. This can give you a slight indication of what you might be able to expect on CPI itself. Because if the PPI increases, we can often see that translate into CPI as producers increase their prices to consumers in order to alleviate some of their rising costs. The consumer prices then rise up as a result. So this is something that we could look at to try and gauge possible trends as to what's going to happen. Now, this month's PPI actually comes out after CPI on the Thursday, but we can use historic data to try and gauge what trend have these data points have been going in, and seeing what relationships between the PPI and CPI of any given month have been. Also, you could look at PCE, the personal consumption expenditure. And this is a very strong gauge of inflation. It's often the Fed's preferred inflation measure, and it shows what the increase in goods and services have been in the same basket that CPI falls in. So it suggests that because they measure a lot of the same things, if the PCE is trending upward, CPI might follow suit. You can also look at something like the employment cost index. And this both looks at what the costs of labor have been, including wages and benefits and the like. And a rising labor cost can contribute to inflation. And that, again, through a downward trickle effect, as the cost of labor and wages increases for certain producers, they then increase their prices to consumers, and you can see how one tends to eventually affect the other. Now, none of these data points are immediate. We're not going to see a PPI rise up and the very next CPI rise up as well. Sometimes that happens, sometimes it doesn't. But trends in these data sets can help us predict what the potential or the possibility of any given direction on CPI is going to be down the road. Think of these as all pieces of a puzzle. You don't exactly know what the whole picture is until enough pieces fit into the puzzle. So it's going to be very interesting to see what CPI is going to look at tomorrow. It is going to be likely an important event. It may not be the juggernaut in terms of number of pips gained for the economic event, but if you're looking to take advantage, it is still something that can prove to be highly profitable. If you're looking to get a little bit more help in formulating a thesis, you can join Chris and Keegan in Project G, the link to which will be in the description down below. And they are going to help put a couple of these pieces to the puzzle to help you formulate what your potential thesis might be, so that you on your own can make an informed decision on what you want to do next. Remember, none of this is financial advice. This is just a little bit of education. I've been Edgar Katashabe. This has been Traders Next Door, and you have just heard the Daily Scoop.